Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be analyzing KKR. As always, this is not individual investing advice. It's just how I analyze stocks. This one came in by request down in the comment section of one of my other videos. If you have a request, let me know. I'll get it on the chalkboard behind me. Eventually, I will make a video for you. I'm making a couple videos a day, and starting today, I'm posting half of those over on the free tier over on Patreon. I think Liedos is the one that I'm putting up over there today. So if you requested that one, it's still free, but it's just on Patreon. It kind of will keep my YouTube feed, clogged out, so it doesn't get clogged up, and I'm not posting more than one video a day, which I think is just kind of too many anyway. And then it will also kind of get people over to Patreon, but it's still free, and I'm still posting them so the public can see them over there. All right, let's get into KKR. Private equity, private investment, real estate credit, all that kind of stuff. I'm really kind of torn on these in general right now because, well, we can do kind of the classic thing and look at the historical earnings. Very cyclical. They were horrible during the Great Recession. We only have data on here going back to 2006. Their peers are very similar. We get these big earnings fluctuations, big declines here during the industrial recession. Probably, I'm guessing this is like oil investment, is my guess. And then another big kind of decline here. And now we kind of have this upswing going on. Big boost during when the COVID stimulus came out. So this should kind of be treated as a deep cyclical. We can look at it real quick and just see how far it drew down to use as a guide. So it drew down 90% during the Great Recession. It drew down probably over 90% actually, so it drew down 50% even though we didn't have a recession here during although I call it an industrial recession. And let's see, 2022, again, not a recession. It drew down probably about 50%, almost 50%. It did actually, because it peaked at 81 and it bottomed below 30. I don't know. It kind of depends on which year we go on here. I guess it would have bottomed at 47, so it's more like a 45% decline. But deep decline for not being in a recession, right? And their earnings also declined off of that big COVID boom. What's interesting is right now they're doing really well. Like they took off this year, they bounced back, and now they're doing well. I generally like these guys for this kind of environment because it's probably going to be pretty volatile. I would say until the last 2 weeks, I liked these kind of businesses because I think it's going to be less, indexing is probably kind of peaked out in terms of its performance for a while, and finding good the problem is this is where the smart money, it's not a problem for them. This is where the smart money is, and the dumb money, I hate calling it dumb, but I mean, it kind of is at this point. It's at peak dumminess, right? So the odds favor these guys a lot more. But the problem with all these type of business, like Goldman Sachs, I kind of feel the same way about. I like KKR a lot better actually. But in general, the problem is getting investors to actually make money, earnings wise. I mean, if you look at the earnings here just coming out of the Great Recession, they earned what, almost $3. We go to 2023 on this little trough and we're right about $3. They had a bunch of years in there where they earned less than that. Shareholders are not really earning that much money by the time it gets to them. I mean, the guys running this are making a lot of money. The guys running Goldman Sachs are making a lot of money. And unfortunately, they have a lot of advantage over individual investors in terms of the sorts of deals that they can do. And a lot of times private equity can kind of take advantage of just inexperience and sometimes gullibility of individual investors and retail investors and index investors. So I like them. I don't like them for that, but I think the businesses are like the environment's good for them. But the problem now is after the past couple weeks, I mean, the macro, if we have a high probability going into a recession, and we can see how they fell 90% in the last recession, the stock price did, and earnings were deeply negative. And so that's a real risk. We probably see it priced into the stock already. I mean, so what did I say 2 weeks ago? Okay, we have to go back a month ago was where they peaked. So almost 2 weeks. And they're down 20% in a month, right? So, and given where this valuation is at 34, I think they could easily fall 90% in a recession. So, a lot of these investments aren't marked to market. You don't really know how much risk there is. We've gone through an environment where risk has been rewarded, I think, generally speaking. And so you never really know how it's going to turn out, but usually it doesn't turn out. It doesn't turn out good if it's like a bad recession for stocks like this. So I think there's just too much risk. I think if a person was going to take a chance on any kind of like private equity, it would be coming out of a trough like this one, maybe a trough like this one, right? How did they do from here to 2020? So 150% return over 1, 2, 3, 4 years. That's good. And that's, not taking too much risk probably. That's kind of the period where maybe you want to think about it. The problem with the Great Recession type stuff is, if you buy a stock when it's 80% off its high, so imagine a stock that's peaked at $100 and you buy it when it's $20 in 2008. If it eventually falls 90% off its high, you don't lose 10%, okay? Your $20 investment goes to 10, you lose 50%. So it's easy sometimes to look at this big decline and say, oh man, if I can buy like when it's 80% off the top. Well, you can, but you're still probably going to be down. And it was actually a little deeper than 90%. You're probably still going to be down 60, 65% at some point, even if you buy almost at the bottom, like what seems almost, even if you buy 80% off the top is what I'm trying to say. So people can get, they think they're getting a good deal a lot of times, say it falls 50% off its high here. Well, if you bought 50% off its high back in 2008, that's like buying at $100 peak at $50. Well, if it fell to $10, you were down 80%. You bought 50% off the high, you thought you were doing good, and you're still down 80%. And it's really hard to keep your confidence as an investor when, especially if you, and most people don't expect it is the thing. So it's always a surprise. Usually people think they're going to buy it at 50% off the high. It's going to immediately reverse and they're going to do really well. Everybody else is dumb for, not seeing this obvious great deal. And then it falls 80%. And then people usually are not stubborn enough to stick it out after that. And even if you do, so here's the thing. So let's say, when did it peak? 24. So let's go down to where it was 12, right? Let's say right here, March 2008. We hadn't even gotten to like October yet. It's 50% off its highs. You buy it. Let's say you hold it until 2020, right? For 10 years, 12 years. We'll do 10. Let's just do kind of an even 10 here. We'll do March 2018. Almost there. There. All right. So you bought 50% off its high. You suffered an 80% decline. And you get 9.5% over the next year. And bond yields back then were, I think, like 5%, like 5.5%, maybe 6%, right? So you barely are beating what bonds were in, 2008. And you have to sit through this like gigantic drawdown. That's for the ones that don't like go bankrupt, right? That's not, what was it? Bear Stearns, Lehman Brothers. Not exactly the same companies, but similar you're taking similar type of risks, right? When you're lending money, when you're buying things on margin and using a lot of credit, all that kind of stuff. It's just risky. And if you ask me, the economic risks right now are pretty darn big, because the problem is the government, I'm going to make another video on this, I think. But I mean, the problem is the government's been pumping money into the economy, which is making the economy do well. And now it looks like that is being cut back drastically. Well, it is being cut back drastically. And it also looks like at the same time, a lot of the potential cushion, you think of like student loan repayments being allowed to be spread out over time, some of them being forgiven, that type of stuff that there seems to be no tolerance for. Well, whatever kind of moral arguments people want to make, the fact is there's going to be a lot of people that go broke, right? And those people are going to before they go broke, they'll run up their credit cards, they'll do what they can, to try to not go broke. They'll make their car payments or whatever, and their mortgages if they have them. And eventually it comes along, they don't have enough money to pay all their bills, and that crushes the economy. They're out in the economy buying stuff, and then instead of buying stuff, they have to pay back a loan or pay it back faster, which looks, I'm just picking one thing out. I mean, there's like a dozen things probably. But the secondary problem is that when trouble does come from this, there doesn't seem to be much appetite to do anything about it. The attitude is, well, it's an individual attitude. It's you're getting what you deserved for taking a loan you couldn't pay back, without realizing that ultimately that's money that's just coming out of the economy, right? And any kind of tax savings is going to happen down the road. It's not going to, if the United States borrows $1 trillion less this year, that doesn't help the economy. Really, it doesn't. It might lower inflation and help lenders a little bit for the people that don't default and the businesses that don't default. But, we'll see what happens. But that's the type of things that happen before you go into recession is the problem. So I think that owning a business that whose stock could fall 90% in a recession isn't something that I'm interested in doing right now. Okay, if you found this useful, if you have any questions, put them in the comments. I'll do my best to answer them, or I'll make another video about them. Hit the like and subscribe button. Head on over to Patreon for the free videos that are going to be popping up over there. They're going to be from the request board here. I think probably the ones that are not in the S&P 500 are the ones I'm going to post over there. All right. Thanks for watching. I'll see everybody later. Bye.